everybody. Happy New Year. First and foremost, many thanks to the entire team at CFC for organizing an awesome event and giving me the opportunity to speak today. Very quickly, folks, by way of background, my name is Mike Higgins. I'm the international CEO and global head of business development at Hidden Road Partners based in London. Prior to helping set up Hidden Road 6 years ago, I spent just over 20 years in electronic trading, multi-asset, and the bulk of my time in the foreign exchange markets. Very briefly on Hidden Road, it's a multi-asset prime broker and clearing firm that was set up and funded by the buy side. So it's a sell side business funded with buy side pension fund capital and capital coming from private credit. We do two things. First is we worked hard to improve the technology behind the core infrastructure of prime brokerage, clearing, and margin financing in traditional markets and applying those applications into digital assets. And we've taken an innovative approach to bring balance sheet into capital markets, including digital, by tapping into the large pools of private credit. And so excited today to talk to you folks about evolution, the evolution that we're seeing in digital assets, particularly on the infrastructure side, and this inflection point that we find ourselves at, and really to explore some of the foundations that are still left to be built out for digital to join the ranks of the other liquid and investable asset classes. And so I thought to start off with an interesting statistic and a few analogies from the traditional markets of what it took and how long it took for those markets to find their mature infrastructure. The Bank of International Settlements, the BIS, did a report in 1995 that showed that foreign exchange turnover was $1.2 trillion a day. Zero of that business went through prime brokerage infrastructure. They redid the report in 2019. And the BIS showed that the market grew to 6.6 trillion, with 1.5 trillion a day going through that prime brokerage infrastructure. So 25 years, multiple iterations on the infrastructure side, foreign exchange properly found its scale. Prior to that, there really was no industrial scale in foreign exchange. There was a few bespoke deals. There was no broad usage. Just some of the mega names had access, like a Soros, a Tudor, a More Capital, and a Tiger of the world, as there really wasn't any convenient way to access the market. And so a lot of institutional capital sat on the sidelines. I think it's a similar story in crypto. A lot of institutional capital sitting on sidelines, lack of institutional grade infrastructure, not really great convenient ways to access the market. And so I thought it was a good analogy that as you lay down infrastructure, prime brokerage being just one piece of that, markets can find their true scale. Specifically for digital assets, I think as this market matures and participation broadens, it'll look increasingly like the FX market structure, but with better legal and technology standards, more conformed technologies, and more robust operating procedures. The other quick analogy I can think of other asset classes evolving is interest rate swaps. Prior to swaps coming online, virtually all debt was issued at a fixed rate. Swaps were the answer to that, as it really helped certain investors receive fixed and floating and vice versa. But the early days of that market were absolutely fraught with issues. Documentation standards were awful. It took the creation of ISDA and many decades for the market to agree on what those standards would be. Collateral and pricing standards were all over the place. It was based on like rating agency standards. But nonetheless, there was this like undeniable demand by the market. And so the market kept refining and innovating to find its space. Again, similar to crypto. The early stages of crypto, we see this resistance to any form of standardization with the theory that the standards are in the code. Collateral pricing and thresholds, again, all over the place. You can look at FTX, 3 Arrows, and the unsecured lending market that blew up. But nonetheless, the market, as it continues to mature, it'll shift towards paradigms and standards that'll flush out a bunch of these inherent inefficiencies. And so, again, I think that's a good analogy. If you look at like the time that took, it was the 1980s when ISDA was first started. Interest rate swaps didn't move to mandatory clearing until 2013, so that's over 30 years. So I think it's fair to say at crypto, we're still very early on. We'll have to see this, how this all unfolds. But I think the age-old saying, Rome wasn't built in a day is pretty applicable here. Yeah, so moving on, I'm sure folks are familiar with the Rogers innovation adoption curve. I'll quickly kind of run through it if folks aren't. But it's the technology adoption curve popularized by Everett Rogers in his book, Diffusions of Innovations. It's the foundational building block of how early and mid-stage investors literally think about the universe, right? It illustrates how different segments of the population adopt technology at different times. It's the core empirical principle used on how technology is adopted. It's VC investing 101. Quickly run through it. According to the principle, there's 5 categories: innovators, early adopters, early majority, late majority, and laggards. Innovators and early adopters are the first to adopt technology, usually due to curiosity and risk tolerance, probably a lot of folks in the room and at this conference. Early and late majority represent the larger audience that wait until the technology is proven and more mature. And laggards are the last to adopt, usually resistant to change. Relevant here, maybe that's the governments, regulators, and perhaps the banks. And so I thought it was helpful to help contextualize where we are. And so the question is, where are we on this? We're in the green area. And so clearly, we have a long way to go before there's full adoption. But what it also tells you is that we're out of the early stages. And so that means that folks are starting to give up this notion that this is some sort of gimmick. It is real. And if it is real, then again, we have a long way to go before this becomes more mainstream. What it also tells you is that the mature users, not the early adopters, they wait until the risk of adopting is significantly reduced. So they will expect mature, known, transparent market infrastructure before they come online. And the good news is that's exactly what's happening and what a lot of folks are building towards. When I think about the transformation and evolution of other markets like electronic trading, foreign exchange, prime brokerage, and interest rate swaps, as mentioned earlier, you can literally point to the curve where those businesses were at different times and observe certain characteristics and see if they match that graph or not. Additionally, there's some arguments that AI is going to disrupt this technology adoption curve. I certainly personally agree with that. We should expect technology adoption to accelerate significantly. AI-driven systems can reduce the frictions, which slows down Roger's innovation curve here, as they take complex products and make those easier to use. AI also can make products more personalized from the outset, and so those early adopters can gain immediate value. And so kind of wrapping up on this point, I think the technology adoption curve is something that we should look at for the evolution of blockchain and digital assets. It's likely that AI will help the acceleration of digital assets and the maturing market structure to allow it to join the other asset classes. But I do think it's important that we follow similar practices and principles that we've seen in TradFi markets and do so in conjunction with the governments and the global regulators. And so at Hidden Road, we've been pretty consistent with this from the start that we think crypto is the 7th liquid investable asset class. It's encouraging. There's lots of folks now referring to it in the same way. Investors, retail and institutional, all have their money invested in 6 asset classes: equities, credit, rates, commodities, real estate, and cash. And crypto is definitely the 7th. And if that is happening, then its trading and investment mechanics will migrate towards best practices trailblazed by the other asset classes. And so this will include best practices in financial transparency, clearing, custody, and credit. It will also force this separation of the function of trading from the function of asset holding and collateralization. The market will attract scaled up intermediaries to provide specialized low-cost functions, so a couple of those being the prime brokerage side to inject capital, more market makers to drive down the cost of execution, and I think the larger, more regulated retail brokers to better serve the individual investor. None of this was given a few years ago, but the world is inexorably moving in that direction. I know for us, the FTX blow-up reminded everybody that in order for the ecosystem to engender confidence, market participants have to recognize the value chain that enables access. And that's what we see happening. I know at Hidden Road, we were one of the first to evangelize that. So nothing really changed in our view. But to dig in a little bit further on what I'm referring to, specifically improved financial transparency, best practices in TradFi are defined as regular financial transparency according to GAAP and IFRS. In crypto, we're just not there yet. There's a lack of certainty on accounting, and that leads to less timely and audited financials. Many of the crypto exchanges have been resistant and frankly unwilling to provide financial statements and balance sheets, let alone audited balance sheets. That's a major problem as institutions have fiduciary responsibility to complete KYC and DD. to face any counterparty. And so it's exactly that reason why you see the larger institutions flocking towards these more transparent, known infrastructures like the ETF and CME, and leveraging intermediaries as they're regulated, transparent, and produce audited financials. Moving along to our current market structure and access point, we've been calling out two issues since we first started. The first was that there was this credit risk in the system that wasn't being valued or priced properly, or really priced at all. And the second, there was these major challenges around the vertical integration of these exchanges. The notion that the exchange is running a marketplace, custodying the assets of its users, and in certain instances running internal market makers, to me, folks, is frankly risky and ripe for failure. And so two observations we've seen over the last 2 years. We're starting to see a major shift from these institutions that use these to price counterparty credit risk. Problem is they're doing that on the run, which is very difficult to do. And so what do we know? We know that the price to hedge counterparty credit risk pre-FTX was near zero, as frankly, folks were willing to pay very little to hedge that risk. We now know that the risk is not zero, but the question is, what is the right price? And frankly, it's hard to figure out what the right price is and find proxies to price it. The second observation is what happened in crypto and is still going on isn't unique to crypto. It's the same thing happened in TradFi in 2008. If you ask folks whether it was conceivable that Lehman Brothers, Bear Stearns, AIG, Wachovia would all simultaneously default on $1 trillion of net liabilities, I think the answer you'd get is something like, not in my lifetime or there or thereabouts. But when this repricing of credit that I was talking about happens, it tends to happen suddenly and usually in the absence of any good information. Again, not unique to crypto. No one really knew what the risks of Goldman were or Citibank post-2008. And so I think as counterparties are coming to terms with counterparty risk, they're paying intermediaries and tri-party solutions to hedge that risk. We're starting to see that separation of the function of trading from the function of asset holding and collateralization with tri-party. And that'll lead to best practices across both of those disciplines. I've been quoted saying this before, but I always think it's relevant. It really is the separation of church and state, right? You'll move from this vertical integration to a horizontal integration with a series of service providers that work together that enable proper access for institutions. And so the faster that the market adopts these financial transparency and customer protection, the faster that repricing of credit I was talking about will happen. I think a good data point we should look for is if a real CDS market pops up. That doesn't exist in crypto, but it certainly does in the TradFi space. And so as we move towards kind of the end of this presentation, I wanted to highlight the great lineup of sessions that we have coming, particularly the next two. One is about safeguarding assets on behalf of the industry, which is hugely important. And the second is how we carefully navigate the liquidity landscape in digital assets. Several of my dear colleagues and friends who are experts in that will go into much more detail, but just very quickly, I thought to share a little bit of color starting on the custodian side. In the last 5 to 7 years, we've seen a significant upgrade on the custody side of things. I'm talking about actual custodians, not self-custody solutions. Half a decade ago, none of those folks had any regulations or licenses, let alone insurance schemes. You basically had some dude who wrote some code who said he's a crypto custodian, told you he was going to hold his assets and safeguard, that's what custodians do, hold and safeguard. Unfortunately, and likely due to greed, several of those folks traded with assets, filed for bankruptcies, there's been hacks, we can go on and on. But the good news is there's a new breed of custody coming out. They're coming out of large financial institutions, and there's an important thing here that they have reputational risk. So it's unlikely that they can cut corners. I think of folks like Fidelity, Zodia backed by SBI and Standard Charter, Kamainu backed by Nomura, SDX backed by Sixth, BitGo as a qualified custodian, and a number of the regional banks that are entering the space. So good news there. We've also seen improvements on their offering. They're supporting more chains in addition to the L2s, which is hugely important because as the ecosystem grows, it will grow cross-exchange. But as the trading infrastructure upgrades, I think custody will be different for different users. The levered users tend to post their collateral as margin and reuse that collateral to trade. It's the unlevered users who are heavy users in the TradFi market of custody. But since the onset of the ETF, perhaps the need to hold digital assets is less relevant for some of those as your custodian can easily hold the ETF. But let me be clear on this. The ETF issuers absolutely need to hold hold assets, and they need custodians to do that. And so at the moment in the US, it's almost 100% dominated by Coinbase. I think, as the market becomes more mainstream, that's very unlikely to continue to be the case. And so this is an area where I certainly see M&A activity from the digital space moving into the TradFi market. And last point, repeal of SAB 121 in the US, specifically for BONI, is a huge thing to watch out for. Bank of New York custodies $50 trillion of assets. It's 50 trillion, and they haven't even started in the crypto side. Moving on to solving the liquidity problem, I'm super keen to hear this panel and what solutions are there. In my experience, a good way to do this is to allow third-party credit to come in through leverage and intermediaries like you have in the TradFi space. To do that, the scale issues we talked about earlier need to really be addressed. What PB and credit providers cannot do is do that in the absence of true transparency and segregation options. Absent putting those things in place, unfortunately, I think there'll be little capital that can enter the market. And so this begs the question for that panel of where is this capital coming from? Who are these credit providers? And is this an area where we'll see innovation and evolution of new solutions? I know at Hidden Road, we certainly believe credit is ripe for disruption and innovation. Most people think about the banks, but the banks have a number of hurdles for touching crypto, as it's currently 100% RWA haircut or risk-weighted asset haircut under Basel III. And so that crushes any economic incentive for the banks to come in and provide credit. There's been a shift in a trend from public markets to private markets, with private markets increasing how much they're funding businesses. A good example of that is Hidden Road. We've been a modern PB funded by private credit and deploying material capital against trading firms and their strategies in the traditional markets, and more recently in the last 4 to 5 years in the digital asset space. We just partnered with a tier 1 global asset manager. It holds $500 billion of assets, and so that aligns us with our strategy to deploy more of this private credit in the space. So again, to my peers and my colleagues on that next panel, do you think private credit is a good example of this? What are the other solutions that the market is moving towards? And so as I wrap up, I'm excited for the rest of the conference and mind sharing with all the folks in attendance. I'm excited for all the progress and that we'll make in 2025. But like in life, it's important to know, where we've come from to know where we're going. And so I thought very quickly to reflect on 2024. Number of innovative products hit the market last year. BlackRock's tokenized money market fund, hugely important. It rates 5%. Crypto, generally non-carry asset, which is a drag on the industry. And so having an asset that pays positive carry that you can use as collateral to trade, I think is hugely important. Stable coins, continue to dominate the market. $200 billion market cap led by Tether and Circle. You will see Ripple and several others make their debut. Certainly strong demand from CeFi and DeFi application is, of course, the cross-border use case. But to me, the crown jewel still goes to the launch of the US Bitcoin ETF. It's important for a lot of reasons. For me, it's important for one, it truly opens the US market. The US market is a very, very equity-centric market. So taking Bitcoin, putting it into a regulated, acceptable equity format was the last and final step to truly open the US market. And so with that, there's been greater liquidity, greater product development, such as options and ADRs coming online, and overall a positive on the Bitcoin native spot market. As bigger entrants and bigger flows demand greater accountability and greater accessibility from this entire industry. And so just as the ETF allowed the US market to gain traction and help overall maturity, this talk of central banks holding digital assets in reserve could actually prove to be the inflection point. If it does become the case that Bitcoin becomes a hard preserved value of money like gold, then it absolutely makes sense that central banks will hold it. Gold's expensive to mine, transfer, and hold. It's expensive and environmentally difficult to get out of the ground. Bitcoin is a much better store of value. Geopolitically, we're in a period of sustained inflation and protectionism. I can't think of a better setup for a hard asset with permanent value that's easy and cheap to transact. The fact that you now have the US market widely involved will allow Bitcoin to find its full expression. 2025 is certainly off to a great year. The evolution of digital asset, folks, is well on its way. Modern technologies and innovative approaches to capital markets is rewiring financial markets and the way commerce is transacted. A light touch, pro-innovative regulation coupled with AI will allow this asset class to transcend outdated and legacy infrastructure. And so I thought to wrap up with a quote from Ray Dalio I found interesting. Evolution is the single greatest force in the universe. It is the only thing that is permanent, and it drives everything. Thank you for your time.
Thank you very much, Mike. I'm going to do something before you get off stage that will make our Swiss organizers tremble with fear. I'm going to break the rules. I'm going to ask you a question on stage because in listening through that, there's a huge amount of content. So that was a really nice summary of 2024. As you look at 2025, is there one particular unlock that you're looking forward to or anticipating that's going to see more institutional adoption? Is there one thing out of there you're like, you know what, this is the thing?
I'm an American, so I'll go with new president-elect in and all the positive rhetoric that we're seeing there. That's clearly going to change the landscape and people's appetite to finally move into this exciting and investable asset class. So.
All right. So the background of being able to do more work and being able to deploy more of the technology that you're working on.
Do that openly without setting up special SPVs offshore. Put the master funds into these things. I think that's what crypto needs, and it'll bring different trading strategies. You'll bring some of the macros in to take punts. Not everybody can be delta neutral. But Anthony, I don't want to get too far in the weeds of the trading strategies, but ultimately the change in regulation and the wind in the sail will bring new users, and this market will broaden and mature.
All right. Thank you, Mike. Anybody wants to ask Mike any questions, he'll be outside after the coming two panels for Q&A, so please do go hang out with Mike outside. Thank you so much. Round of applause for Mike, please. Thank you.